Lioutas from PSK Private Wealth, here to give you another investment update. We finally have a deal on the US debt ceiling front after more than 100 days of negotiation. It seems to be an issue that comes up fairly regularly these days given the size of the US debt pile, which is north of US $30 trillion. The deal was struck at the very last minute. There was conjecture around when they would run out of money, not a exact science, but a deal was struck last week in the Houses of Parliament in the US and signed into law by President Biden over the weekend. Nothing unusual around the arrangement in terms of leaving it to the last minute. What was unusual though was the details of the deal. So the deal effectively has no upper limit, which is unusual. Normally they do set a dollar figure in which they breach the next time. It does extend the debt limit through to post the US election, so January 2025, and gives both parties breathing room going into that election. So I think both parties will claim victory in that they won't have to deal with the debt ceiling this time next year again, leading into a US election, which both didn't want to deal with, but it got through with very little concessions, which was the interesting part. So a big chunk of the Republican Party wanted some fairly significant fiscal concessions, and very little actually went through to make a meaningful debt in that debt pile. As is always the case, it will be talked about for some time, but the positive to come out of the deal is that markets have since settled with the deal. There was a fair bit of volatility going into the negotiation, and as we need an end date close to potential default, markets have become more volatile as well. So markets pretty comfortable and happy with the result achieved. Both sides of politics come out of it fairly clean, to be honest, and it does remove a risk in markets. There's obviously a variety of other risks in markets, but it does remove a fairly significant risk in market in terms of the US potentially defaulting, which is something that nobody wants to see. Well, China officially reopened post-COVID in November last year, and it got off to a very quick start in terms of people being let back out again after, I think it was more than 2.5 years, fairly severe lockdown in that country. The interesting part about the reopening is that in Western world, in Australia, when we were locked down, we were provided with significant stimulus. The government paid us a lot of money to stay at home, to comply with orders. In a communist-controlled country like China, you don't have to pay anybody to stay at home. And so they were asked and told to stay at home and forced to stay at home with very little to no significant government stimulus. And so when they did reopen, the reopening was always going to look very different to Western world reopening, where our reopening was stimulus fueled. So we had money we never had before, and as humans, we went out and spent all of it, or most of it. The Chinese didn't have that. They had excess savings, which they were very cautious and have been cautious about spending again, with no social security safety net in China. So the reopening was always going to be patchy. The interesting thing is that markets obviously saw a very quick reopening in November, December off a very low base, but have been somewhat disappointed with reopening since. And it was always going to be patchy given the lack of stimulus, which is yet to be provided. So the Chinese government had made it clear that they would only provide stimulus as a last resort and specifically where needed, but they wanted to see how the economy reopened and where it settled. So they weren't going to front run that with significant stimulus and then have excesses in the system like the Western world did with regard to inflation. So it's a long, settled, patient approach to reopening, and it's probably a 2 to 3 year reopening event, if you like. But it increasingly looks like the Western world, and in particular markets, are becoming increasingly impatient with the pace of that reopening. And so more recently, we've seen economic data turn back down and remain weak in some areas, and markets responding quite negatively to that data. We're patient investors, we're long-term investors, so we are obviously watching that data. But for now, we remain fairly comfortable with the long-term outlook and the reopening of the Chinese economy over a multi-year event. Yet another video on interest rates and inflation. I'm not sick of talking about it yet, and it's something we'll be talking about for some time. It has driven markets over the last 2 and 3 years and continues to drive markets currently. Inflation, headline inflation in particular, has definitely come down off its highs in all jurisdictions around the world. That was always going to be the case. But what we've seen more recently is core or underlying inflation, which is the more critical aspect that central banks focus on, has started to re-accelerate upwards again. So it's actually going in the wrong direction. And that is really around services inflation. and in some countries in relation to property or rent inflation as well. So it is starting to go in the wrong direction, which means central banks have had to come out and be a little bit more severe and significant with their tone and their rhetoric around further rate increases and or potentially leaving rates at higher levels for longer. If we rewind a couple of months, markets were starting to anticipate central bank pauses in rate rises and then also potential reversals, so cutting rates in Q3 and Q4 this year. That expectation has largely come out of markets. There's now little to no expectation of rate cuts this year, so they've been pushed out to next year. Markets have reacted accordingly. Whilst inflation problem hasn't been solved for, good to see inflation continuing to fall in terms of the headline number, but we really need to get the core inflation under control, which is really around services. What's holding it up is unemployment. Unemployment remains very, very low, or employment remains full, as they like to call it. And so we need to start seeing a weakening in labour markets, I think, for that service inflation component starting to come down. The other thing that could be done to deal with this is in relation to productivity growth. Something the RBA talked about more recently in terms of productivity growth being very low. And if we could increase the economic output of the economy, that would definitely help from an inflation perspective as well. All in all, the outlook remains little unchanged, but there is some risk of inflation reaccelerating again, which central banks need to get on top of. So the much heralded rate cuts for Q3, Q4 definitely won't be coming through at this point. Likely to be an event for 2024. And markets will anticipate that further over the coming period. We get asked a lot of questions around recessions and the potential for recession in Australia in particular. And so it's probably easier to talk more broadly about global conditions at the moment, and I'll come back home. So in terms of offshore markets, the US, as it currently stands, is likely to lead into recession. So we have all the economic indicators flagging an impending recession, but they have been flagging that for some time now. So that is something that markets are dealing with at the moment, in that we should have probably been in recession in the US already, and we're not there yet. And what's conflating or conflicting economists and other analysts is really around the strength of the labour market. It is really strong at the moment, and it hasn't rolled over just yet. And that is longer than historically does happen in a rate hiking cycle. In relation to Europe, Europe's economic situation looks okay for now, but it has the potential to get messy again, and that's really in relation to their energy situation. They went through a milder winter last time around. They can't expect that to happen or save them going forward, so they'll need to deal with the energy security consequences of not having Russian oil and gas online, whilst the economy now begins to slow with interest rates significantly higher and employment starting to soften a little bit as well. Closer to home in Australia, we actually are and remain the lucky country. We are the least likely to head into recession, and our economy is in good stead at the moment. So forecasts for economic growth are around the 1 to 1.5% range from the RBA and from the government, and that looks likely. What's helping us? The commodities base, as it always does, the agricultural base, which it always does as well. But we also have a fairly strong employment market at the moment, and it looks like we will hold out of recession. We have strong immigration now starting again after a period of pause, which will definitely help with economic growth, but will also put pressure on inflation. So we are the lucky country, we remain the lucky country. It will feel recessionary for some individuals locally, in terms of us falling from very high levels of economic growth to lower levels, but it's unlikely to be a recession that we will see in the US and Europe later this year or early next year.